Welcome to Insider Events Master Your Money, how to control your debt, build your credit, and set yourself up to build wealth. Here's our host, Insider's Executive Editor, Personal Finance, Libby Kane.
Hi everyone, and thanks for joining us. Today, the truth behind good debt and bad debt, when a credit card is a good idea or not, and how to be smart whenever you need to, or choose to, borrow money. In 7 years of covering money at Insider, I've learned that everyone has an experience with debt. Some people avoid it at all costs, some people consider it a necessary evil, and some people use it as a tool to build wealth. No matter what our experience with debt, though, we all have more left to learn. This event is part of Insider's Master Your Money series, presented by Fidelity. Master Your Money was created to help millennials like me take control of our financial future. As you follow along, please share your thoughts on social media using the hashtag MasterYourMoney. And if you have questions for our panelists, you can go ahead and drop them in the Q&A box at the bottom of your screen. After our event, we'll be collecting feedback in a short survey, so please stick around to answer a few questions if you can. For today's discussion, we're lucky enough to be joined by two personal finance professionals. Kelly Lannan is the Vice President of Young Investors for Personal Investing at Fidelity. Hi, Kelly.
Hi everyone. Hi, Libby. So happy to be here.
Thanks for coming. We're also joined by Tarra Jackson, who is an author, speaker, and former credit union executive, who you might know by her other name, Madam Money. Hi, Tarra.
Hey, how are you?
Well, thanks. Thanks for coming. Before we get too deep into our conversation about credit and debt, what does one have to do with the other? Tarra, could you fill us in?
Absolutely. So, credit and debt is normally synonymous with each other. Credit is the trust that's extended by someone or an organization, in this case, money, to purchase something and pay back later. Debt is the obligation that's owed by the person. That's the technical realm. But usually, with my thing, credit is leverage that you can use to help build wealth, and debt is the amount that's owed. And so, good debt and bad debt comes into play. Bad debt for me is the debt that causes financial frustration, financial stress, or anything like that. But usually, most people think that it's synonymous, but it's really the mindset and what you think about credit and debt. So, I use credit to leverage some of the things that I do to build wealth, and I minimize my debt, the amount that's owed, so that I have enough money to do other things to build wealth.
Tarra, I love your point about good debt and bad debt. Could you explain that a little further?
Sure. So good debt is relatively like the credit that's leveraged. So the good debt, your mortgage, if it's going to help you to buy your home. It could be your car. It could help you buy your home. The bad debt, some people think bad debt is finance companies or any, what do you call those? Payday loans. Yeah, payday loans. And so with those payday loans, those are usually bad debt. For me, good credit is or good debt is the debt that you can afford to pay back without it being a financial hardship. Bad debt is any type of debt that causes financial hardship because you could have a mortgage and that could be good debt. But if you can't afford to pay the mortgage or it causes financial stress or financial hardship, that can turn into bad debt. It's almost like that, good credit or good debt is that boyfriend that gives you everything that you want, and the bad debt is the boyfriend that just takes, and you don't get anything out of it. So we have to be very
Also, the
cautious on
boyfriend
how
that's
we
hard to
leverage that.
avoid. Sometimes that's the boyfriend that's
Absolutely.
most hard to avoid,
Yeah.
as we've talked about previously.
That's why I'm still single. I don't know. It could be that.
When we talk about different types of debt, one that always comes to mind, of course, we see it in the headlines all the time, right, is student loans. So I was wondering if you had any tips for paying back a huge, overwhelming amount of debt like a student loan. Kelly, did you have any thoughts?
Yeah, and just to build on what Tara said is that often how I see student loans, and that doesn't mean it doesn't, feel burdensome on you or like add to any of the emotion. But often when I do think of student loans, I do view it more as good debt because often people, whether they want to or not, have to take on student loans in order to finance their education so they can get a better job one day, so they can do what they want in life one day, or heck, even attend a school that they're really passionate about. And when I think of debt, I think of student loans as one type of debt. I know for millennials particularly, we're often known as that student debt generation because so many of us have student debt. But I think the first step to really knowing how to pay off your debt is assessing the different debt you have. Student loans might not be that only form of debt you have. So you do have to first take a step back and confront some of that before you even start paying it off. But I will share this, and this is what I think sometimes confuses people or definitely makes people pause when I speak to them, is that the very first step before you even think about paying off your debt is actually saving for something that we like to call an emergency fund. So I know, bear with me, everyone, because again, I know it can be confusing because Libby, you just asked me, well, how do I pay off this debt? But the most important thing is that you need to make sure that you have money set aside in case the unexpected happens. Because, guys, let's be real, look at 2020. I mean, if anything was unexpected, it was that year, right? And so, what we don't want to have happen is people are not prepared for the unexpected and then they go further into debt because they either can't pay off the debt that already existed or they have to take on more loans to do so. So, step one before we even think about paying off the debt is definitely tackle that emergency fund first. Money set aside in case the unexpected. And after that, honestly, there's a variety of rules. And unfortunately, there is not a one size fits all. For some, they might prefer something called the avalanche method, where they actually take a look at their debt, take a look at the interest rate, and they actually tackle the debt with the highest interest rate first. And then there's another method, the snowball method, where again, you're taking a look at the debt under your name, and instead of tackling the ones with the higher interest rate, you're tackling the lower balanced amount. Because for some, if you can tackle that lower balance, it's almost more motivating than kind of tackling that with the higher interest rate first.
Absolutely. I just want to add to that. She's absolutely brilliant and right on all parts. Love her. So, especially when you're trying to save, that first step of saving, a lot of people like an emergency. It's also an opportunity account as well. So don't just think of it, something for an emergency. Think of it for an opportunity. You may want to go on vacation. You may want to do something. So it's building that safety net in the event that you need liquid funds. And I always say have it in a mama account, a reverence account, because a lot of people have their savings account tied to their checking account. And when the checking account can't give them what they want, they tap that asset. I said asset of the savings account, and then they're always depleting that savings account. So it's very important to put that savings account in a financial institution that's separate from your checking account and set it and forget it. That's the best way to build up your savings is by setting it and forget it. Have a certain amount go to that account and just don't touch it, don't get access to it, don't get a debit card, ATM card, or anything. What I love what she said about tackling the student loan debt is if you have the opportunity and you have multiple student loans, is the snowball effect. I kind of need wins. You know what I'm saying? I'm that chick that I need some wins. So I'm going to take the smallest balance, pay it off. Yay. I'm going to then take the money that I use and apply it to the next one. If you have the opportunity to tackle the larger balance with the larger interest rate, go for it. But for most people, we need those financial wins. So, snowball effect, especially with student loans, is really a great option.
I should have known that we could have an entire separate conversation about saving money. And I also should have known that talking about paying off debt was going to strike a chord with a lot of people because we already have some questions from our audience today. Somebody actually asked a really interesting one about reducing large amounts of debt. How do you pay off a large sum of debt when you have more debt than you even earn in a year, right? Your income is lower than your debt. Where do you even start?
Hmm.
Well,
Yeah, and I think
that's a
that's
challenge in and of itself. Go ahead,
go
hon.
ahead, Tara.
Go ahead. I mean, that's a
No,
challenge
you
in
go
and of
first.
itself. That's a challenge in and of itself when you owe more than what you're actually making. So, one of the things I would recommend is to talk to your financial institutions. Find out if they have a deferment program for some of the loans, find out if you can refinance, find out if there is a financial hardship thing because you can't give what you don't have, right? So, you want to tackle the debt or the credit or what, your obligations are more than what you're actually making, and so that means you're going to have to find some form of assistance. Okay. And most financial institutions really All they want is the money. When I was the interim president CEO of a credit union, there was a lot of people that had financial hardships and they wanted to give up their car, give up their house. We really don't want the collateral. We just want the money and we're willing to work with you. So contact your financial institution, try to see if they have a program for hardship or if there are other options. Maybe you can split up your payments, maybe you can lower the payment and extend the term of the loan. So when that's the case, I do recommend communicating with the financial institution to see if there are some options to help you pay down the debt.
Yeah, and I think that's great advice. And I think that just brings up another important point is that so often in Tara and Libby, I'm not sure if you've seen this, is that people talk about debt as it's separate sometimes from the rest of your finances. And it really
Right.
can't be. It's part of that full financial picture. It's just not that your debt lives over here, your investments live over here, and your savings live over here. It all goes hand in hand. And that's why I go back to debt and savings does often go hand in hand because think about a time when you maybe did save more and you could have paid off your debt quicker. Or think about a time when you had money saved for that emergency fund and you didn't go further into debt. Or again, think about a time where, you didn't bulldoze your way through debt and you didn't save for your future. And so you couldn't go on those trips or retire and you had to work till you're 125 years old. So now again, of
125,
course,
love
that's
it.
easier. I know, seriously. Now, of course, it's easier said than done. And so I just want people to know, and Tara, I go back to your point a lot, is that if you do find yourself in just a crazy amount of debt and it feels overwhelming and it's constantly burdening, you can overcome this. You can take small steps to get through this. Maybe
Yeah.
it's skipping a meal, maybe it's figuring out a way to save a little extra money each month, and more importantly, like celebrate those wins, celebrate the small and the
Yes.
big. I think often we hear these success stories, after someone pays like this huge loan off, and that's great, right? We should celebrate them. Like this
Mhm.
woman I work with creates cards to celebrate people paying off their student debt, which is awesome. But let's also celebrate those small wins. And if you're tackling it on a weekly or monthly basis, those are often things that you should celebrate and make sure you pause and reflect on that. And if it works for you, stick with it. If it didn't, try something else. So that's another thing. We don't want people to get too, discouraged because there are ways to both, dig yourself out of debt as well as build your credit too.
I love what Kelly is saying because it is one body. Your financial being is one body. It's just like saying, your heart is separate than your lungs, which is separate than your liver. It all works together inside of one body. And when one it has a dis-ease in it, then it affects every other organ around it. And that's why I wrote the book Financial Fornication. And I talk about financial dis-eases. And it's because if it's one error that's causing you the dis-ease, it's going to affect. So if your debt is the dis-ease, it's going to affect your savings. It's going to affect your investing. It's going to affect everything around you. So you have to look at it holistically as one financial being, one body. I love that, Kelly.
That's a great point. We have just reader questions or viewer questions coming in like crazy. I do want to ask you another one. I know that you both mentioned, you have options. You have options to pay debt. Someone asked specifically, what's the best way to consolidate debt? Kelly, would you start?
Yeah. So, to be honest, one of the things that I lean into the most is there are so many wonderful free tools out there, free guidance out there that actually let you help you take that first step in getting all your debt in one spot so you can take a look at it. So, I would recommend, honestly, and maybe you start with if you have a workplace retirement account, start with that company. Your student loan company, if you have student loans, they have tools like that. I would often turn to that. I'm someone who does operate in a more digital manner. So if I can, pick a tool where I can put down all my debt, consolidate all my accounts, see it in one spot, that's something that's very beneficial to me. And often it's these tools that can actually help provide recommendations on the best way for you to consolidate the debt. The other important note, okay, because I know there's probably a lot of people out there in the public sector, these are also tools that can warn you because sometimes if you consolidate your debt or refinance your debt and you work in the public sector, and you're on like the 10-year forgiveness plan, you will no longer be able to forgive that debt after a certain period of time. And this is something that people
Right.
don't realize, and it's terrifying. The amount of stories
Yes.
I've heard from people who went and refinanced and they didn't realize that they no longer have their debt forgiven after that specific period of time. And so that's why I often do turn to tools like that versus just a blind Google search, because it's overwhelming, right? Google's the best and worst thing. It's like WebMD too. You Google your health and, oh my gosh, my arm's going to fall off tomorrow. So that's why I often turn to these things to help me understand what I can consolidate, what I'm able to refinance, and more importantly, what I might not want to, because I don't want to risk losing that public forgiveness. So that's very important. And that would be my first step recommendation if I ever wanted to approach consolidating some of my loans.
Yeah, when I want to consolidate my loans, I actually look at the numbers. One, you have to figure out how much you can afford to pay. And a lot of people don't know that, but you'll have to really create that spending plan. I'm a spender, okay? My financial language from my book, For Financial Languages, I'm a spender, okay? And so when I hear budget, I hear diet, die, deprivation, I can't. And I don't have time for that negativity. So I relate to a spending plan, which is a budget for all of you all savers. And so when I look at my spending plan, it tells me what I can spend or how much or where I want my money to go. When I make the decision of where I want my money to go, I can then figure out how much I can afford to pay in debt. When I figure out that much, then I need to figure out all of my debt. And if I consolidate it, what interest rate will I qualify for? And if I can get it at that payment, how long will I be paying it? And in some cases, if your credit is colorful, you may have a higher interest rate, which means that the payment you may can afford may extend the loan out significantly, which would not be beneficial to you financially. So, understanding your spending plan or your budget and understanding how much you can afford to pay is very essential because that can help you make some major financial decisions. Also, it will also give you an opportunity to change some of your spending habits, right? So there was one time, I got to tell you this story. See, what had happened was I decided I wanted to do my spending plan for a month. And when I looked at it, I paid $1,200 eating out. Yeah, don't judge me. $1,200 eating out. When I saw that, I said, no, I'm not giving this money to food and, other things, right? So I decided that I was going to cut back on that. Now, I didn't go cold turkey, but I said, instead of me eating out every night, maybe I'll eat out 3 times a night, and that will cut it half the time. And so, with that extra $600, not only was I able to save more, but I was able to put more towards debt so I would not have to consolidate. But if I did need to consolidate, at least I have the disposable income to be able to pay more. So I know that was beating around the bush, but sometimes we have to look at the numbers to determine if consolidation is the right choice. And if it is, what is the best plan for you financially?
Yeah, and
And to
Tara, I
this
think you
point,
made a good point, and I just want to say this too, because I don't know if anyone else is like this. Um, Sometimes if you're scared of the numbers and what they're going to show you, it's like inertial sets in, and you don't check them, you don't look at them. Do you know what I mean?
Right.
So like, I just have it to do, okay? Because I know some of you guys are multitasking during this call, which is totally fine. Good. We're just happy that you're tuning in. Do us a favor, okay? One action item that I want each and every one of you to take while you're listening to us today: go and check your credit score. Okay. Can you do that for Tara and I? Can you go and check your credit score right now? Because there are so
Please.
many. This is literally just one example, right? Is that there's so many people who are afraid of what that number is going to be. It's like, when you were little and the report card used to like get mailed to your home before it was just online, and you'd like go and hide it from your parents because they didn't want to see it for
Kelly,
like
you're dating us. You are so dating us.
exactly. Yeah. I remember. And, like, it was like a paper score, like a report card. And then now
Yeah.
it's all online. But still, I just want everyone to do that because, like, you said a very important thing, Tara. It's like sometimes you got to lay everything out, even if it's going to scare you. But if you have no idea what you even have to begin with, how can you ever take action on it? So, again, just a little plug action item during today's session, because those are my favorite type of sessions. Give me something to do. Please make sure to check your credit score while you're listening to us talk today.
Yeah, go to annualcreditreport.com, get your credit reports, get the scores. There are several apps out there that can get you the scores, even though it could be educational scores. That is a number that you need to know. It's almost most people are afraid to look at their financial numbers and they're afraid to look at their health numbers. So they don't even know their blood pressure, their blood sugar, their cholesterol numbers because you're afraid. It's just like being afraid to find out that you have high blood pressure, but you know you have high blood pressure. Really? But you don't want to get it fixed because you don't want to know numbers. But then you're going to get a heart attack. Okay, same thing, right? So know your financial numbers. If the numbers scare you, now you know what they are so you can change them. That's the great thing about finances is that you can change the number. There is life after, there's resurrection. So even if the numbers look bad, you're just having a bad financial hair day. Now we know what we need to do to fix it up, but you got to know your numbers. Great point, Kelly.
I do want to be very clear for all of you who are writing down, check my credit score in your, apps or notes or scraps lying around your desk right now. You do not need to pay for your to find out your credit score. You can get it for free. It is actually a lot easier to get than your blood pressure. So it's like a 5-minute project at most. I do want to switch gears a
I
little bit.
love
We've
that.
been
I love
talking.
that. I have to say that I love that you said getting your credit score is easier than getting your blood pressure. There's no excuses now. That's so awesome.
It's so
Great.
cool. A lot
No
of credit card
appointments needed.
companies, right? Like they give it to you. Like you can check every time you,
Yeah,
you log in now. You know what I mean? Like
yeah,
some credit card, like Discover is another great example. Like you don't even have to have an account with them. You can check and that will not affect your credit score. Ladies, I don't know if you've ever
mm,
gotten this question before. Oh, but when I
yeah.
check my own credit score, it's gonna bring my credit score down. No, 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 no. That is a myth. You can check your score every single day if you want, every single hour if you want
Yeah.
to. It's only when
You can
others are inquiry on yourself that can sometimes impact your score.
exactly, but keep in mind that the score that you see is not the same score that financial institutions see. It's not the same score that um, uh, utilities companies see. Okay, so there are hundreds of scoring models that FICO, that Fair Isaac do, variations of the scoring model, but the score that you get is a good indicator of where you are on the spectrum of your credit score. So it's great information to have to help you figure out how to move forward or backward. Well, forward, always forward.
And we did get a clarification question about exactly that. Somebody said, what's the difference between your credit score and your FICO score?
So the credit score, the FICO score is a credit score. It's just that there's variations of the scores. So each credit reporting agency has a variation of FICO. So you have your Beacon score, you have the FICO score. I think there's a new score that's out there, and they're called different things. So each credit reporting agency may have a specialized score because they include different information in there. But the main FICO score, the anatomy of the FICO score is your payment, how you make your payments, the length of your payments, the diversity of what kind of payments, how much new credit you have, and how many people look at your credit cookies, your inquiries. Okay. And so the FICO is the FICO, but there are different scoring models that may include some additional information, that what makes the variation. That's why Experian credit score is different than Equifax, which is different than TransUnion, but they all get it from the same scoring model, which is Fair Isaac. That's the mothership, Fair Isaac.
And I do want to be super clear. If you check your credit score, if you do your action item and you cross it off and you say, great, I've checked my credit score, I did what Tarra and Kelly told me to do, I am now done for the next 5 years. Is that the case,
No.
Tarra?
Nice try, Libby.
Yeah, I know, right? Yeah, nah. I wish I could have stopped looking at my scale at 130 and just be that same size for the rest of my life. Just doesn't work that way. So look at it on a regular basis because you never know what's on the credit report. It could be information that's not even yours, could be incorrect information, and that all affects your credit score. So think of your credit score as your grade, your financial grade, right? And you have classes, and every time you pass a class or fail a class, you get a grade. And that accumulative score is your GPA. Well, the credit score is your financial GPA, and it's based on all the credit that's inside of your credit book or your scoring. So all the creditors that's there. So you could have passed a class, but on your report card, it's showing that you failed. So you need to go to the teacher and say, what's up? I passed this class, right? So it's the same thing with your credit report. There could be information that's outdated, it could be incorrect, it could be not even yours. So that can have an effect on your credit score. So it's very important to review your credit score as often as possible, as well as the contents in your credit, annualcreditreport.com. You can get a copy of your report for free on an annual basis. So I say check it at a minimum of every year, but I check mine quarterly. I'm just, anal like that. I like seeing the numbers go up.
Yeah, and I think that's really important though, because often I hear too often people are only checking it when they're looking to, for example, buy a home or get a car loan, and then they're so surprised what they see, and it's like you could have maybe done, taken steps to get that score improved or correct something that's not right. So that's the last thing we want is people to be checking that at a certain event and then very surprised when the number they get back if they wanted to get a rate, on a mortgage, for example, is very high. Because I think that is
Yeah.
important and something that I just want to make sure that we touch upon too, because it's something that surprised me. When I graduated college, like, a little over 10 years ago now, like credit was something that really kind of rocked my world, to be honest. Like I didn't correlate the fact that my credit score, or in my case, because I didn't have a credit card coming out of school, that could affect me actually having the ability to rent an apartment. When I got a
Hmm.
job 7 years ago at Fidelity, I didn't realize that they would actually check my credit score
Hmm.
and that could affect my job. I didn't realize until we bought a house about a year ago how important it was to have a healthy credit score and the rate that I was given by our mortgage lender. So often, like, we hear all these concepts in sessions like this, but we don't tie it back to real life. But those are just three examples on the importance of, having a good credit score can have on your actual life, and more importantly,
Hmm.
the goals you might have in life, the things that make us happy. So I just want to make sure we do correlate the concept of credit to all of those things we have in life, whether it's trying to get a new job, buying a home, getting a new car, etc.
I agree. You should not be surprised at your score when you go and do a major purchase. You should already know what the score is, or relatively what the score is. If you go and apply for something and you're baffled by the score or you're baffled by the rate, you didn't do your homework before then. So if you're planning on doing any type of major purchase, a home, um, or a car, or a new job, make sure you know what's on your credit report. So if there's incorrect information, you can fix it, or you at least understand where you are. So if you get a rate, it's based on the score that you know about. No one should tell you something that you should already know.
Hmm. Yeah, ladies, I have a confession to make. When I and I might have told you this when we were prepping. I thought my debit card was a credit card because I was
Oh my
swiping
God,
and
yes.
using my credit card. So I like didn't put that together because my parents wonderful people, but they were people who told me not to get a credit card because they were so afraid of the negative impact. So when I got out of school again, I was in a real shock because the landlord came back and was like, "Hey, everything's good, Kelly, but like you need a co-signer for this apartment." And I was like, "Well, why?" And they're like, "Well, you don't have any credit history." And I was like, "What do you mean? Like I've had a debit card since I was 15." And like stupid Kelly, I didn't equate the two things, that they were very different. So again, I just tell that story to A, make fun of myself, and B, let y'all know that since then, I did get a credit card, obviously been in the game, and have taken steps to really build up that score over time.
And
So.
it's not uncommon for that. Most young adults that are getting into credit, they do not know the difference between credit and debit cards. And when they're swiping, and everything. So the debit card, it acts as a credit card based on how the transaction is processed, but that money is coming out of your checking account or savings account if it allows, but usually it's your checking account. Okay. And that debit card is not reporting on the credit report because you're not borrowing any money. There's no credit tied to it. The credit card, on the other hand, is that trust, that money that's given. You have a line of credit, and every time you swipe the credit card, it's pulling from that credit card. So now you owe that money back. That becomes the debt that you owe. But if money, when you swipe and the money is automatically taken out of your checking account, that's a debit card not coming on your credit report, is not going to be seen on your credit report. I don't care what they say, the prepaid cards that are debit cards, don't believe the hype. But the credit cards, because now you have an obligation to the financial institution, you are pulling credit and you're paying it later. That is what's going to report on the credit report. So it's not uncommon. Most young adults believe the same thing, Kelly. So don't beat yourself up because it's not taught in the schools. It's not something
Oh, what
that
the
you were
heck?
taught in the schools.
What did I do
And many, right.
differently?
And then parents can't teach you what they don't know, right? So there's a lot of things that they may not know, but they don't want to show that they don't know it. So they just don't tell you. And then we learn based on trial and error, heavy on the error, and then we figure out when we grow up and learn. And so I've made major money mistakes trying to do it trial and error. So I don't want people to feel bad if that's what they thought, because nobody told you any different. But today, now you know.
Now you know. Kelly brought up an interesting point about people being afraid of credit cards, and I'd love to dive into that a little bit. I mean, a lot of people feel that way. We hear from people often who feel afraid to use credit cards. They get into their mid 20s or even their 30s, and they've never had a credit card because they thought it was, bad or dangerous. What's the right way to use a credit card? Kelly?
Yeah, so I don't know if there is a single quote unquote right way, but I will give a piece of advice. I give this to a lot of younger people because in my job I do have the opportunity to travel to schools, to travel back pre 2020, to talk to a lot of students, a lot of people kind of just starting out for their finances for the first time. Because I think it is really important, at least when I look at credit, I really think of it in two ways. It's the credit that you can use, whether that is, buying a loan, or excuse me, taking on a loan, or, student debt. And then it's the credit you build, and how you build that credit can determine how you use that credit. So for a lot of younger people, especially if they're just looking to build credit for the first time and often getting their first credit card, one piece of advice that I often give to them is, yes, get the credit card. However, if you wanted to build credit in a more responsible way, and maybe you were afraid of abusing or putting too much on that card, aka more than you physically have in the bank, put a single reoccurring payment on the card. Your Netflix bill, your Hulu, if you're not already sharing with five different people, put one of those single payments on that card. Set it to automatic payments. Tara already talked about the importance of automating your life. That goes for everything, whether it's credit, debt, your savings. Make things automatic. You don't have to think about it. You're not going to miss the money. Put a single payment on that card. Set it to automatic payments so it pays off consistently each and every month, and hide the card from yourself. There is absolutely no shame in hiding the credit card from yourself. Put it in a drawer, put it somewhere where you're never going to see it again, and continue to use that debit card if you're at all worried. So this is especially for those who are just starting out. Whether you are in your early 20s, mid 20s, or even early 30s, and it's a safer way to possibly build up credit in a more responsible way than just kind of blindly swiping it. So.
Okay, so I'm going to have some real talk with everyone watching. Okay, everybody ready? Real talk. So if you're starting out and you're trying to build credit, I tell people all the time, if you can't afford to save, then you can't afford to borrow. Okay. And if you're just starting out and you want to get a credit card, I recommend getting a secured credit card. They don't really look at your credit because it's the collateral is the cash that you save. So if you can't afford to save 500, 300, even $1,000, then you probably aren't quite ready for a credit card. Okay. Because that goes back to what Kelly said, is that we need to first establish some form of emergency or opportunity fund, even when we're trying to pay off debt. But before we even get into debt, right now, your probably debt is very minimal. So you can save as much money as possible. But when you're saving that, you can now use that cash as collateral to help you build your credit with a secured credit card, whether through a credit union or through a financial institution. So do that. Also, we're all adults here. Based on my book Financial Fornication, I do want to throw this out to you. Credit is like sex. Just because you can doesn't mean you should. But if you do, use protection, a budget. Make sure that you know where your money is going. So when you do decide to use the credit card, you know how much money needs to go to it. Kelly had an awesome suggestion to put something that's reoccurring, that's on there, that's minimal. And you want to keep that balance to your credit limit at least 30% or less, or pay it off, right? So if you have a $500 credit card and you use up to 500, make sure you can afford to pay off 500. You don't necessarily need to carry a balance to build credit, but you do need to pay it off or pay on it on time on a regular basis. And so what I did with my son is that we got him a secured credit card. He did what Kelly did. He has his Netflix or whatever, because I make him pay for both of our Netflix. So he gets the Netflix on there. And so he pays that on a regular basis, which is an automatic payment from his checking account to do that. And that's how he's establishing credit. So we're just saying to be responsible with it, but that's an exercise and a tool that we're going to have to grow into, and it takes practice. So start smart and save, and then build up to building credit that way.
We did get a question from our audience specifically about credit cards, but I think we could probably extend it to other types of debt as well, which is it effective to make only the minimum payment? Tara?
No. That was a quick answer. No, it's not effective to make the minimum payment. I mean, as a financial institution executive, yeah, it's great for me because I get a whole lot of interest off of you. That interest income is phenomenal for me. But for you, you always want to pay more than the minimum payment so that you can hit the principal. Usually, the minimum payment will cover the interest that is accrued and some of the principal, and you'll find that you'll owe the principal for a very long period of time. In order to tackle that principal and pay that debt down as fast as possible, always pay more than the minimum payment. Now, if you're in a financial situation where you can only afford, at least pay the minimum payment on time, but always do your best to pay more than the minimum payment.
Yeah, and I think that's another one of those habits that we talked about, at least when you're first starting out. If you can pay that sucker off in full each and
Yes.
every month, if only for practicality reasons, right? Like if you're buying
Yes.
something that's $200, you're only paying the minimum, guess what? Interest kicks in. And now
Mhm.
you didn't just pay $200 for the thing. You're probably paying 220 for it and 250, et cetera, et
It's
cetera. So
250. Yeah,
you know,
exactly.
you don't want to do that. You just want to pay what you originally got that. So just think of it that way too. No one wants to pay more for younger and starting out. Please try to pay that sucker off in full each and every
Yes.
month. Nothing will make your debt grow quicker than interest. And as we've already talked about, sometimes that's not the only debt that's on your plate. So we want to make sure
Right.
that we minimize that as much as possible.
Oh my God. And if you can pay it off every month. So I pay my credit cards off every single month, right? So the interest, I don't care what the interest rate is. The interest could be 50%. As long as I don't keep a balance, I'm paying zero interest, right?
Yeah.
So a lot of people like, well, I don't want to get this secured credit card because it's 20%. Well, pay it off and it's 0%. So get in the habit now while you have the least amount of debt to pay off your credit card, because once you get older, and you've accumulated so much debt, you may not financially be able to. So get in that habit of, using it and paying it off, using it and paying it off. And that is that's 30% of your credit score right there. And if you pay it on time, that's 35%. So that's 65% of your credit score that's going to be positive right there.
I do want to pivot a little bit to make sure we have time to talk about debt through kind of another lens. We've been talking a lot about avoiding accruing it and paying it off quickly. One thing we haven't really touched on, though, is using it smartly. That's even a word. Being smart about how you use debt to build wealth in the future. People talk about leveraging debt. And I'd love to get into kind of what that means and how people can do that if they're in the right financial position to make it happen. Tara, could you start?
Sure, I love leveraging debt, or leveraging credit to build wealth. So, like for example, real estate investing is really awesome because you're leveraging the credit of the mortgage to get a real estate property, and then you are renting it out, and or you're flipping it or whatever, and you're getting income from it. You're paying the loan off, but you're also getting um, additional income from it as well. So being able to leverage credit as a tool to help you build wealth is what it's meant to do, right? Other people's money, OPM. It is great when you have the opportunity to leverage OPM to help you build wealth. The problem is most people are using the tool incorrectly. They're using other people's money to finance a lot of liabilities, and those liabilities do not produce any type of income. So you got to be very careful if you leverage the credit to purchase assets or something that will become an asset. That is what's going to help you to build wealth. But if you continue to use um, credit to buy those shoes and buy purses and technology or whatever that are liabilities, you may not be able to make income, or it's not going to become an asset to you, not unless you get those really expensive shoes. What are they, red bottoms? No, they're not worth it. No, but yeah, get use leverage credit to purchase assets that will produce income, and that's going to help you to build wealth.
Kelly, did you want to add?
Yeah, I mean, I couldn't say it better. I think that, and it kind of almost goes back to where we started from, the good debt, bad debt conversation.
Exactly.
A lot of times, when we think about debt, we do think about the negative, right? I mean, I think honestly, when we first mention that, everyone has a negative feeling. But I think Tara gave some terrific examples on how it can be a positive and how it can help you in the long term, whether that's using it to own a home one day, whether it's just the one home that you're going to live with, or in her example, possibly leveraging that in the real estate field, or if it is once again taking on some debt to put you through college or give you education to one day have a great job and further build your wealth. So I think it kind of all comes full circle. And again, I think that if more people started trying to think about debt in more of a positive way versus always a negative way, that would definitely help shape their mindset and hopefully help them build those stronger habits, because they'd be working towards something versus obviously paying down maybe mistakes or things that make them feel bad. So I think that's also very important.
I agree with Kelly. Don't allow other people's mistakes with debt and credit dictate your relationship with credit.
Mhm.
Okay. So there's a lot of people that may have had bad experiences with a credit card, coming out of college, or bad experience with a mortgage, or bad experience with credit or whatever, but that was their experience. Your experience may be completely different. And if you do it the right way and you do it smartly, as like we're talking, it could be magnificent. It could be that catalyst that helps you get to your wealth faster. So, a lot of people are going to say, credit cards are bad, only use cash, but that may not be what's best for you and your situation and the things that you want to do and your financial goals. So determine what your financial goals is. It's just like one person's financial success is different than another person's financial success. What is your financial success? You get to dictate that, and then figure out how can you use or leverage credit to help you get there.
I love that point. And before we wrap up, I did want to give you both the opportunity for people who have been, multitasking, or people who are watching carefully and taking notes. What is the one thing you hope people take away from this event today? Kelly, do you want to start?
Yeah, I mean, I just first want to say, and I say this all the time, like anyone who took the time to call in and listen to this, you're already taking an important step in the right direction. I might not have done this if I was at the age of some of you, especially if you're younger, for a while, because it was almost out of sight, out of mind, didn't want to think about it. So I first just want to say, like, kudos to each and every person who actually took the time to listen in. And hopefully you did take me up on my action item. But I think one of the most important things, and I think of it as twofold. The first thing is the importance of thinking about in terms of your overarching financial picture. All too often we think about it in these separate buckets, but it all comes together. And that is one day that can really help you live the life you want. So I think that's, option or the one of the most important things. The second big thing, and you could kind of see this in some of the questions, and I know we touched upon it, is that if you do find yourself in debt, whether that's credit card debt or another form, or maybe you haven't started building credit, it is never, ever, too late to get started. And it's never impossible to dig yourself out of a bad situation. Okay. Celebrate those small wins, celebrate the victories, never give up. You will get out of it, because the great thing about debt and credit is that there's a lot of things you can do to dig yourself out of it. So I think that's really important.
Yeah, ditto to what everything Kelly said. I really want one kudos for you listening in. If you are on here, I am so proud of you. I'm excited for you. I can't wait to connect with you. But this is probably the time in your life where you may have the least amount of debt. If you're younger in life, the older you get, the more in debt you get in, and it's just a natural cycle. But if you are at that beginning stages of building your credit, save as much as possible. Save something sooner, okay? Because you want to put that aside, not just in a savings account, but you want to contact Kelly, because they will be able, or, Fidelity, and create a brokerage account or start investing or something. Because the sooner you do it, the younger you do it, the faster your money is going to grow. Compound interest. But the compound interest works against you when you have a lot of debt that you hold over time, because that compound interest on loans will grow your debt. So try to minimize the debt as much as possible. Leverage your credit. Pay off your credit cards. You can do it smartly. You can use credit, and it can make a world of difference in the acceleration of your financial wealth. People do it all the time, but some people do it the wrong way. But you're going to do it the right way, just because Business Insider gave you this information. I'm just saying.
Thank you both so much, Tarra, Kelly. It was such a pleasure to have you here today. I want to make sure to tell everyone who's tuned in that there will be a recording of this event available on Insider's social media channels. And if you learned something today, you can learn more on June 22nd, when we're going to have another Master Your Money event, in which we'll break down a topic on everyone's mind, home ownership. Also, a reminder, in a few moments, there should be a survey popping up on your screen where you can tell us what you enjoyed and what you'd like to see next time. Finally, please just join me, in thanking our panelists, thanking Fidelity for presenting. Tarra and Kelly, you had some great words about credit, debt, and building wealth, and thank you for your work helping millennials master their money.